Before we begin, please support the channel by subscribing, liking, and sharing this video. Constructive discussion is always welcome, and we invite you to share your views and insights in the comments. All right, the source document we're diving into today is called US Market Peripheral Notes, and the date on it is April 15th, 2026. This video presents a direct informational narration of the source document. Okay, before we get into the thick of it, the usual but very important stuff, this is for informational and research purposes only, not investment advice. You know, investing has significant risks. You could even lose your principal. So just remember, all the views we're about to cover are for reference only. So here's what we're going to cover. First, we'll look at market and geopolitical dynamics. Then we'll dive into technical and sentiment indicators. After that, we'll talk about funding and liquidity drivers. Then some interesting sector and stock developments. And finally, we'll wrap it all up with a risk assessment and strategy. All right, let's jump right into our first section, market and geopolitical dynamics. And the big theme here is this pretty dramatic shift. The market seems to be moving away from fears of conflict escalation and is now starting to price in peace. So, what's going on with the geopolitics? Well, there's a huge disconnect between what officials are saying and what the media expects. You've got the AP and Bloomberg reporting a potential grace period agreement. Then you have Trump out there declaring the war is over. But on the other hand, both the White House and Iran's foreign ministry are pushing back, saying, hey, hold on, no agreement has actually been confirmed. And this really brings us to the key takeaway here. And I'm quoting directly from the source. The market has clearly chosen to price in peace ahead of confirmation. It's not waiting for the official green light. So why is the market so confident? It seems to be operating on this underlying triple win logic. Think of it like this. The United States gets to claim a political victory, Israel gets to ease some of that intense survival anxiety, and for Iran, the IRGC can keep its hold on power. The market's take is that none of these three parties really wants a full-blown fight. And if you're looking for one key signal, one leading indicator that this peace agreement might actually happen, watch the price of oil. The magic number is $90. If oil falls below that, it's a huge tell. Okay, moving on to our second section, technical warnings and market sentiment. And things are getting, well, a little wild. The report describes the market as entering a sentiment loss of control zone. Just look at the NASDAQ. It has been up for 11 straight trading sessions. 11! And not only that, it's decisively broken through a huge psychological level, that 24,000 super round number threshold. Now, if you look at the Relative Strength Index, the RSI, it's getting up to the extreme level of 90. And that, right there, is the classic signal of what the report calls a sentiment loss of control state. The market is getting very, very frothy. On top of all that, we've seen 3 upside gaps in a row. Now, from a technical perspective, that's a big deal. It suggests that the buying momentum is just getting exhausted. It's like a rubber band being stretched to its absolute limit. All right, let's talk about what's actually fueling this rally in Section 3, funding drivers. We're looking at liquidity and quant fund behavior. And the key idea here is that this is more of a liquidity spectacle, not some fundamental return to value. So who's been doing all the buying? A huge part of it has been corporate buybacks. They were at record levels in the first quarter, acting as, and I quote, the ultimate buyer of last resort. They've been putting a really strong floor under stock prices. But here's the catch, and you'll want to mark your calendars. In mid-April, we hit the buyback blackout period for earnings season. And just a few days later, around April 20th, all that buying power from CTA quantitative funds, it's projected to be completely exhausted. It's not just the big players either. Looking at retail and algorithmic behavior, we've seen short covering happening at the fastest pace in years. Hedge fund net long exposure. It's in the top 15% of its historical range. And then you have retail investors just piling in, maximizing their leverage with those 0 day to expiration or 0 DTE call options. This whole gambler-style behavior forces market makers to buy stock to hedge, which pushes prices up even more, creating this positive feedback bubble. Okay. Section 4, let's look at what's happening in specific sectors and with key stocks. The big story? This euphoria isn't just in the big blue chips anymore. It's spreading out to the more speculative names. Let's take ASML as an example. Their Q1 results were great. They beat expectations, even laid out a capacity plan for 2027. But their guidance for Q2 was 8.7 billion euros, which was actually below what the street was expecting, at 9.07 billion. So a bit of a mixed signal there. And for a classic shoe shine moment, a sign that we might be in the late stages of this euphoria, the report gives this incredible example. Get this. A wool boot company on the brink of delisting changed its name to include AI and surged 582% in a single session. Wow. If that's not a sign of indiscriminate speculation, I don't know what is. This brings us to our final section, number 5, risk assessment and near-term strategy. So what do we do with all this information? The key is to watch for a shift, a transition from this vacuum rally to what's called high-level distribution, which is when smart money might start selling. So there are 2 really critical time windows to keep your eyes on. First is this Friday, which is options expiration. That's when all that extreme gamma positioning has to settle out. Then, early next week, right around April 20th, we could see a buyer vacuum form. Why? Because that's when the CTA buying stops and the corporate buyback blackout is in full effect. So it really all comes down to this one question. With the tide of liquidity about to go out, how is the market going to react when it finally has to stand on its own 2 feet?